Stocks are shares of a company. So what does that mean? Imagine a company as one large pie, and that pie is divided into 8 pieces. When you own one of those 8 pieces, you're basically owning 1 out of 8 shares of that company. By holding on to shares of a company, you can make money in 2 ways. Number 1, by dividends, and number 2, by the appreciation of the shares of the company that you're holding on to. First, let me explain to you what dividends are and how they work. Dividends are money that a company pays to their shareholders for owning shares of their company. The amount of money that a company pays and the time when they pay that money is entirely dependent on the company itself. For example, imagine 3 different companies: Company A, Company B, and Company C. For simplicity purposes, we're going to assume that all 3 of these companies are divided into 8 shares, and you own 1 share of each of these companies. Company A decided that they would pay their shareholders 60 cents for every share that they own, and they would pay this money every 3 months, meaning 4 times a year. Company B decided they would pay their shareholders $1 per share, and they would pay this money biannually, meaning twice a year. And lastly, Company C decided they would pay their shareholders 15 cents per share, and they would pay this money every month. So by the end of the year, from Company A, you make $2.40. From Company B, you make $2. And from Company C, you make $1.80. You think to yourself that, wow, you're making money just by holding on to shares of a company, and you're not even working for it. It's almost like your money's working for you. So you decide for the new year, you're going to buy more shares. You made the most money from Company A, so you think to yourself, you're just going to buy more shares of Company A. But your friend Tom talked you out of it and explained to you that it's best to diversify your portfolio and not to put all your eggs in one basket. You listened to your friend Tom and you bought 1 share of each of the 3 companies. So now you have 2 shares of each company. For simplicity purposes, let's assume that each share of each company cost you $20, both when you initially bought them and this time when you buy them for the new year. Throughout the new year, Company A's business continues as usual, and they continue to pay you 60 cents per share every 3 months. So by the end of the new year, you make $4.80 from Company A. Company B doesn't perform too well in the new year and their business declines. After 6 months into the year, instead of paying $1 per share in dividends, they decide to pay you 70 cents per share. Also, their share price drops down to $15. By the end of the year, they decide not to pay any dividends at all, and their share price drops down to $7. The drop in share price is not due to the company paying less dividends. I'll explain in a bit why the share price dropped, but for now, you make $1.40 in dividends, and the value of all your Company B shares at the end of the new year are worth $26 less. Doing some basic math, if you were to sell Company B shares right now, you would lose $24.60. Holding on to Company B shares, your net worth from Company B right now is only $15.40. Now, let's get to Company C. At the end of the first month, Company C pays you 15 cents per share as usual. Company C had been working on some strategic plans to greatly expand their business. If they're able to implement their plans, they'll become more profitable and valuable. To implement their plans, they'll need more money. So they decide, instead of giving away a portion of their earnings to shareholders, they'll stop paying dividends and instead use that money to expand their business. So for the rest of the year, you don't make any dividends from Company C. But because Company C's business is growing and expanding, their share price appreciates in value, and each of Company C's shares are now worth $35. Doing some basic math, your net worth in Company C is now worth $70.30. This takes us into the second way of making money from stocks, by share appreciation. When there's more demand for something and less supply, its value goes up. And when there's less demand for something and more supply, its value goes down. In the case of Company C, because it's growing and expanding, and because it's very likely to be making much more money in the future, more investors now want to purchase more of Company C, which drives up demand. A higher demand will create lower supply. This high demand and low supply of Company C shares is what drives up its share price. In the case of Company B, however, because its business is going down, investors don't find it very attractive and are less likely to want to buy it. Many investors are probably even trying to get rid of their Company B shares. This creates an excess supply of Company B shares. This excess supply and low demand is what drives down Company B shares. your total net worth from all three companies is now $130.50. You originally paid $120 from buying all the shares, so you made money. You made the most money from company C, and you lost money from company B. So you think to yourself, instead of buying any of company A or B shares, you should have just used the entire money to only buy company C shares. But what was the likelihood of you knowing that company C would come up with such a strategic plan to expand their business? As a matter of fact, what if their plan doesn't work out and they end up losing money? By investing in only one company, you put yourself at risk of solely relying on that one company. And if anything was to happen to that one company, you could possibly lose a lot of money. That is why it is always recommended to not put all your eggs in one basket and to diversify your portfolio. By diversifying your portfolio, you minimize your risk and slowly make money over time. But how do you choose the right companies that'll make you money? At the end of the first chapter, I told you that you can invest in sound companies where all the research and fundamental analysis are by default completed for you in the background. And that's what we'll get into right now. ETFs, electronically traded funds, are basically groups of companies that are packaged together and sold on the market like stocks. There are different kinds of ETFs for different purposes. So now the question is, who makes these ETFs? And what kind of ETFs are out there? There are many different companies that offer ETFs. Some of the top issuers of ETFs are iShares, Vanguard, SPDR, Invesco, and Charles Schwab. They offer ETFs with different purposes. For example, if you go on the Vanguard website and look at the list of all their ETFs, you can read the names of the ETFs to get an idea of what each ETF is about. For example, looking at this ETF with ticker symbol VGT, the title of the ETF is called Information Technology ETF. This gives me an idea that maybe this ETF consists of technology stocks. When I click on the ETF and read the product summary, it tells me that this ETF includes stocks of companies that serve the electronics and computer industries, or that manufacture products based on the latest applied science. If I scroll down the page, I can see some of the top companies in this ETF are Apple, Microsoft, and Nvidia, among many others. Vanguard takes care of all the research and manages what companies will be packaged into this ETF. Because Vanguard is taking care of all the research and management for you, they charge a small fee, which you'll notice under the expense ratio. Different ETFs have different expense ratios. For VGT, the expense ratio is 0.1%. That means for every $1,000 worth of VGT that you hold, you'll be paying a $1 fee. For me, that is a very good deal, so I can focus on other things in life, while Vanguard manages what companies to hold for me in the background. We covered a lot on stocks and ETFs, and how ETFs can be an excellent investment choice. The information that I provided gives you an excellent beginner's level understanding of stocks. But there's a lot more in-depth knowledge that can still be learned. I plan to convey the knowledge to you from the ground up. So I plan to cover the more in-depth knowledge in a later video. This is it for this video. Thank you, and I'll see you in the next one.